Good morning, everyone. Happy Friday. This is John Kogan. I'm the CEO and founder of Performative, the online community for corporate finance, accounting, treasury, and related professionals. I would like to welcome everyone to this webinar entitled Revenue Recognition and the Impact of EITF OB01 and 093, also known as ASU 2009-13 and 2009-14. There have been many far-reaching changes in the area of revenue recognition for multi-element arrangements and for certain hardware-software combinations. A lot of companies will be affected by these new regulations, and we are happy to have you here with us today to learn more about the changes. And there are more changes coming, in fact, so not only are they completely changing things now, but there are a lot more changes on the way. We're going to hear all about that from our first speaker this morning, and we'll get to those introductions in a moment. We won't be able to cover all of the issues in full depth on this webinar, but we wanted to lay out the basics and a bit more at this point so you can at least ground yourself in the coming changes and determine where you may need to learn and do more to prepare. And certainly, you could do no better than working with our sponsors. I would like to thank McGladrey and NetSuite, firms steeped in the technical accounting and technology ins and outs of these and all other areas of revenue recognition. They have made it possible for us to deliver this event to you for free today. And certainly, if you have follow-up questions or would like to learn more, as I said before, you couldn't do better than these two firms. A brief note on today's agenda. First, we will hear brief presentations from our two speakers, about 20 minutes each. Then we will move to a panel discussion where we will spend the remainder of our hour. We would like this to be an interactive experience for you. So if you have any questions at any time, please go to the questions area in your GoToWebinar control panel and send us your questions. We can't promise to get all of them in, but we'll do our level best. And if we don't get to your questions, then we'll do our best to follow up with you afterwards if at all possible. You might want to take a look at the chat panel. I threw a couple of messages in there earlier. Number one, we will send out soft copies of the presentation to all attendees. There were a few late changes, so we did not have a chance to get those out to you prior to the event. I apologize, but those will go out soft copy, typically within 24 hours of the event. We are also offering CPE credits for the CPAs in today's audience. Many folks pre-sign up for those. That's great. You'll get your certificates in email. If you did not, if you neglected to sign up for them, you'll see in the chat area an email address for our event manager. She also manages our CPE program here. Just drop her an email and she will get you taken care of. Okay, before we hop in to the content itself, just a quick introduction for those of you who are new to Performative. Performative is the largest and fastest growing online resource for corporate finance, accounting, treasury, and related professionals. We are a completely ad-free, noise-free community. We reach well over 250,000 CFOs, controllers, treasurers, and others. And we do things like this. We talk to one another. We help educate one another. It's a wonderful resource, uniquely valuable online peer network, lots of subject matter experts, and great features and resources. And all of it is completely free and what we call noise-free, which is to say there are no ads on the site. There's no fee to join the site. Nobody's allowed to sell on the site. It's a wonderful oasis of quiet. It's just a great place to learn so that you can do your job more effectively. So feel free to check us out at performative.com. We'd love to see you. So why don't we go ahead and move into the main part of our program. And to lead us off here, I'd like to introduce Bob Burke, who is a partner at McGladrey. Bob is a partner in McGladrey & Pullen's assurance practice and has over 20 years of audit and business advisory experience. Bob leads the firm's technology industry practice group, a dedicated team of partners and staff focused on delivering strategic, innovative solutions to companies ranging from startups to prominent publicly traded companies. He is highly accomplished in the areas of mergers and acquisition and financing transactions for both public and private companies. Bob has extensive experience in SEC accounting and reporting matters, including Sarbanes-Oxley compliance. He also advises clients on accounting and financial reporting matters, as well as business and industry issues. Bob is here to tell us about revenue recognition and some of the changes that we've seen in EITF OB01 and 093. And now that those changes have been out for, I guess, a year and 2 days has been effective. Bob, we've got some lessons learned as well, so we'd love to have you go ahead and jump in with us on 08-1.
Thank you, John, and thanks to all today listening in. As John mentioned, I think we still kind of refer to these as the new rules, but they've actually been out for a little while. We've seen a number of companies early adopt these rules as those rules permitted, but we're now in the zone of required adoption for calendar year companies. So I'll give a brief background on the rules just to make sure we're all on the same page, and then I'll kick into a little bit longer discussion about some kind of lessons from the field as we've been working with our clients, the early adopting clients, on some of the issues that we found. So kind of a quick summary of the rules. Many of you are familiar with the predecessor rules, the old EITF OB01. A lot of frustrating moments here for many companies that had elements that seemed eminently separable, but companies could frequently not separate these units because they could not demonstrate that they had fair value for undelivered items. So the newer rules allow for more flexibility in determining the values of the separate elements. And these rules really replace that slice of the old EITF OB01. Now the codification reference is 605.25. So you'll see here laid out are the rules relative to how to determine if you can separate an item and assign value to it. And you'll see that the second of the three criteria has been stricken. And this is really the fundamental difference between the old rules and the new rules. It's worth pointing out that the first item still applies. I think there's been a lot of excitement around the new rules and some of the flexibility in assigning value. And it's definitely worth the level of excitement that it's gotten. But sometimes overlooked is the idea that the first criterion has not changed. The delivered item still has to have value to the customer on a standalone basis. And if it does not, you really cannot avail yourself of the more flexible value allocation rules that are allowed. But assuming that you can meet that first criterion, as well as the third, as we'll see here, the removal of the second criterion and its replacement by some new guidance is really the game changer in ASU 2009-13. So instead of a strict fair value regime for assigning value, we now have something called the relative selling price method, which again eliminates that pure fair value standard, and as a result is also led to the elimination of the residual method. I think the net sum of all of this is that many companies applying these rules are going to find that they're able to recognize revenue earlier, and I think many would argue more consistent with the economics of the underlying transaction. So we have a hierarchy that we must use in assigning value to elements in a multiple element arrangement. And the first two items here probably look very familiar to you because they're unchanged. You start with vendor-specific objective evidence of the selling price, our old friend VSOE. If you got it, you got to use it. If you don't have VSOE, you move next to third-party evidence. I think experience has taught us that third-party evidence has been somewhat of a struggle. I've rarely seen third-party evidence cases succeed, but it is the second leg of the stool. And this is where many companies under the old rules would throw their hands up and say, I don't have either of these, so now I end up with accounting that does not match economics. And so the good news is that we have this new third criterion, the best estimate of standalone selling price. And because there's no exception here for practicality, you will always have to apply this third line item on the hierarchy if you can't meet the first two. And because following this hierarchy, you will always be able to assign value to all the elements in a transaction, there's no need for the residual method any longer. So the residual method has been explicitly prohibited as a means of allocating value between items. And as I'm sure we'll learn a little bit later in the presentation, this has pretty significant systems, a pretty significant systems angle to it as well. So the difficult part in applying the new standard, I think there was initially a lot of excitement around the idea that management could estimate a standalone selling price, but that excitement was quickly subsided when companies started to look at this a little bit more deeply and found out how hard this really was. So the freedom that you gain to assign a selling price does come with a price, and the price is a lot of work because it's not easy when you're used to such a prescriptive set of rules to then kind of turn you over to your own devices to come up with something. And the guidance is not of much help. There's nothing in the published literature that prescribes a specific methodology. There's lots of vague guidance out there that doesn't really contribute much. You gather all your data points, adjust it based on market and entity-specific factors, consider all information available to you. There's a lot of motherhood and apple pie there, but what there's not is a lot of stuff that can really help you decide, where do I start and what do I do next. So as a result, we've found for our early adopting clients that calculating a management's ESP has proven to be quite a challenge. So what I've done on the next few slides here is, I think true to the theme of this webinar of lessons learned, is I've both looked at my own experiences as well as experiences around my firm for approaches that have worked and approaches that have not worked. And I guess we'll start with the good news. Here's the next couple of slides. We'll talk about some things that do work, and kind of batting lead off on the things that work is a cost plus reasonable margin. I think that this is probably an easier one for a lot of companies to get their arms around. I mean, after all, when you're setting the price for a particular product or service, this is a logical thing to do. Before we decide how much we're going to sell something for, we ought to figure out what it costs us to deliver it and what we think, what kind of return we want to get. So this is one that I think has been successful for a lot of companies. But my little caveat here is that if your costs are not significant, if they're highly variable or difficult to predict, or if your costs consist primarily of research and development-oriented costs, that approach is going to prove to be a real challenge for you. A couple of other things that are worth considering is as you work your way down the hierarchy and you do a VSOE analysis and that doesn't work, and you try a third-party evidence analysis and that doesn't work, it's tempting to want to discard all of that information and say, well, I failed on those two lines on the hierarchy, so now I have to come up with something completely new. And that might be true, but before you abandon the data that you've accumulated in doing a VSOE study and a third-party evidence analysis, keep in mind that the data that you accumulated there may be very useful in your management's estimate. I mean, a perfect example of that is in a VSOE analysis where maybe you've got really tight pricing data, but you've got a very limited sample size. You can't assert VSOE. Or maybe you've got a large sample size of standalone sales, yet the data is a little too dispersed relative to a bell curve that you would need in a VSOE analysis. That information, while it isn't VSOE, might be very helpful in terms of making a management's estimation. And the same is very true of third-party evidence. You may not succeed in finding somebody who sells exactly what you do, standalone sales, availability of price lists, but you might find stuff that's similar, and maybe there are differences in geography or differences in volume that need to be adjusted for. But again, that failed attempt at determining a third-party evidence study may, in fact, be useful for these purposes. The next point is something that you probably know. Contractually stated prices or price lists can't be presumed to be evidence of VSOE or anything. But if you've put a lot of rigor into setting your price list, or you've done a lot of analysis around what price to assign to something in a particular contract, that analysis may be very useful. If you haven't, those price lists aren't terribly useful. But think of a situation where you have a pricing committee, and again, before deciding what you want to charge the outside world, you do a lot of analysis in order to set that price list. That information may be very useful in doing your management's estimation process. A couple of cleanup points on some things that do work. You can weight different estimates. If you've taken a couple of different whacks at this and you've got a couple of different endpoints, you can weight them. And you can stratify your estimated selling prices based on geography or volume or anything else that might be relevant as a part of your analysis. So now we'll move on to a couple of things that don't work, and most of these, quite honestly, are the kind of the reflection of the things that do work. But as I had mentioned earlier, unsubstantiated reliance on stated or contractual price lists, contractual prices or price lists certainly is a convention that would not work. These next two items are ones that I've certainly fielded questions for a client that has been routinely applying the residual method, meaning they have VSOE for everything except for one thing, and they want to use the residual method. There's a can I just keep doing what I'm doing type of question there. And the answer is no. You need to assign a value to each and every item, and you need to allocate the discount using relative sales price method, not the residual method. It is expressly prohibited. And I've certainly fielded the question for companies that have kind of gotten used to a world without VSOE, and they are used to single element of accounting, amortize the bundled arrangement over the life of the arrangement, and they've become accustomed to that. There is some resistance to applying the new rules. Can I just keep doing what I'm doing? And again, the answer there is no. To the extent that the delivered items have standalone value, and therefore they are separable, you must follow the guidance in the new rules to assign value to the individual elements. So those couple of items are things to keep in mind. A couple of other things that don't work. One of them is racing right to the third item on the hierarchy and going deep into a management analysis of standalone selling price when you actually haven't tackled the first two items on the hierarchy. I guess I can't emphasize that enough. This is hierarchical. You must assess whether you have VSOE or third-party evidence before you can use a management's estimation. The next item, constantly changing prices from period to period without changes in the underlying facts and circumstances. One of the unfortunate perhaps side events or side effects of freedom is that some people out there will use that freedom to manipulate their pricing. And so I can certainly envision a situation in which a company is struggling to meet their earnings in a particular period, and even though the underlying facts and circumstances have not changed, there's a desire to move estimated selling prices around to achieve a particular revenue recognition objective. Obviously, that would be out. The opposite is also out. I think many more companies will decide that, or will assert that this is really an awful lot of work, and they want to do it as infrequently as possible. So there'll certainly be some inertia, I think, on the parts of some to even when facts and circumstances are not changing, to try to leverage work that was done many, many reporting periods ago, and that would be equally unacceptable. You need to be constantly vigilant around internal and external conditions and update your estimated selling prices as appropriate. And then lastly, to the extent that you are not applying the old guidance correctly, you can't use the adoption of the new guidance as a means of kind of covering your tracks. If in the process of going through the adoption you determine that you were not properly applying 0021, you'd still need to fix that and call it a restatement as opposed to the effect of a change in accounting principle. Hopefully we won't see too many of those. In terms of some of the disclosure items, I think the disclosure items are fairly well known at this point, and thankfully there was, I think, been a pretty healthy collection of early adopters, but there's really no shortage in the public realm of some of the disclosures. But there's a variety of quantitative and qualitative disclosures that are required around how you've made your assessment, what kind of inputs and methods that you've used. Keep in mind that the new multiple element arrangement guidance can be adopted either prospectively or retrospectively. It's too late to adopt it early, but if you adopt it prospectively, you do have to make some disclosures around the impact on prior periods as well. And so if you're adopting it prospectively, just a reminder on the adoption date, this is for fiscal years beginning on or after 6/15, so that means Q1 for calendar year companies. Obviously, for privately held companies, if you're a public company, you've already done this in Q1. But for our privately held companies, they'll get the balance of this year to try to straighten that out. So, kind of part and parcel with the new multiple element arrangement guidance. The EITF did, for a brief moment in time, consider whether it was worth changing the multiple element arrangement guidance that is specifically relates to software companies in the old SOP 97.2. 0021 and 97.2 had different multiple element arrangement guidance. When these rules were being rewritten, the question was asked, do we still need two sets of multiple element arrangement guidance? Ought we not change the software rules as well? And the software rules, for those of you who know the industry, are even tighter than the old 021. They're very prescriptive, entirely VSOE-centric. And unfortunately, the answer to that question was no. They did not change the multiple element arrangement guidance for software companies. But the good news was they made it easier to escape the software revenue recognition rules in their entirety by via this ASU 2009-14. So this ASU really changes the game for whether you are in the software rules or out of the software rules. Kind of under the old regime, it was very easy to get swept into the software rules. So the software rules clearly apply to an enterprise software company, but if you were a telecommunications gear manufacturer, that's a piece of hardware that's got a lot of important software on it. Or you made a particular medical instrument, again, a tangible product with lots of important software on it. Many companies in industries outside of software, companies that do not think of themselves as software companies, were frequently swept in to the software rules. ASU 2009-14 makes it a lot easier to get out. If you produce a tangible product that contains software, where the software and the hardware combine to provide the essential functionality, you can exit the software revenue recognition rules altogether and apply the new multiple element arrangement guidance to your transactions rather than the much more stringent rules in the SOP 97-2. So if you're an enterprise software company, you are out of luck. But for companies that make tangible products, again, ranging from medical lasers to iPods, have been fleeing SOP 97-2 at a record pace. A couple of cleanup points here. The software elements don't need to be embedded on the device in order to meet these standards. What's really important is simply that the software and hardware are working together to provide the essential functionality. And this is more of a product line analysis, so you may find that some products will get out of 97.2, but others of your products may not. The adoption date and adoption methods here mirror the new multiple element arrangement guidance, so there's nothing new on this slide in terms of the timing or the manner in which you adopt the new rules.
Great, Bob.
And that's it for my formal presentation, but I thought I would chime in with one kind of late-breaking development from yesterday. I'm frequently asked, many of you may know that there is a very, very thorough and wide-sweeping rewrite of the revenue recognition rules coming from the FASB and the international standard setters. Just yesterday, the FASB and IFRS folks, or IAS folks, announced that they would be issuing a second exposure draft, having received a huge volume of comments from last fall's exposure draft, and I guess having decided that they're going to make changes that are substantive in nature. They're never required to send out a second exposure draft, but they in their announcement they recognize the importance of the new revenue recognition rules. This new exposure draft is scheduled for release in Q3, and they said that they will have a new 120-day comment period on that. So for those of you wondering when the new rules will be issued and when they'll be required, the answer is no time soon, but we'll all get kind of a second bite at the apple when that new exposure draft comes out in Q3.
And are we expecting relatively significant changes once we hear back? I mean, the changes were relatively significant in the original exposure draft. What's your take on that?
Boy, it's hard to say, John. The original exposure draft comment period attracted just right around 1,000 letters.
Wow.
And they weren't all pats on the back. I mean, there were some. I was a part of our firm's committee that I'm not going to claim to have authored our firm's response letter to the FASB, but I was on our firm's committee that bubbled up issues. And as the FASB has been redeliberating on some of the elements of that, from the definition of an obligation to the performance of service arrangements, I think was scheduled to be very different, but was fairly onerous. I think it's unclear as to where exactly the changes are going to be, but those are a couple of areas where, as I've been kind of following the chatter relative to some of the redeliberations, I think those are some areas where you can expect to see some changes in the new exposure draft.
Okay, great. Thank you very much. So major changes and then more major changes to come. I guess that's guaranteed employment for everyone in the accounting and audit industry. Before we move on to our next speaker, I've had a couple questions in from folks who must have signed on late. We will get soft copies of these presentations out to everyone. That typically happens within 24 hours. Of these events. And also, if you have any questions at all for the speakers, we are going to be moving to a panel discussion after our next speaker. And we look forward to taking on any specific questions that you may have about these regulations, implementation, or any other questions related to this subject. So with that, why don't I go ahead and introduce our next speaker. His name is Ranga Bodla. Ranga is director of the software vertical at NetSuite. He has more than 15 years of product management experience in software and technology industries. Prior to joining NetSuite, Ranga led worldwide governance, risk, and compliance marketing at SAP and led efforts to establish them as a leader and visionary in the space. Prior to this, Ranga held positions at Pilot Software, Hyperion Solutions, and IBM's WebSphere. Ranga, thanks so much for joining us today.
Thank you, John, and thank you, Bob. It's a pleasure to be here with presenting with you guys. So as I think I want to start off with and talk a little bit about, as Bob mentioned at the beginning, these rules have been out for a bit now. It's not something that just came out yesterday. Although they're obviously, as Bob said, a lot of late-breaking news. One of the big things is when we, as a company, started looking at this in 2010, we decided that we wanted to be at the forefront of this and decided to become an early adopter for whatever pain and suffering that entailed. That was something we decided as a company. And so in 2010, we started down the path of being an early adopter of EITF OB01 and looking at it and saw that it was definitely going to have an impact on us and that we needed to do a lot across the organization in order to be effectively to undertake this. And as we really looked into this, and I'll go through this in the course of my presentation here, we'll talk a little bit about this. But I mean, one of the big things we early on realized is this is going to have to be automated. I think many of you that are looking at this know that requires a separate spreadsheet for each of the different orders. As we were looking at our growth rate and our continued growth rate, we knew that we were going to have to eventually manage thousands of estimated selling prices. Selling across multiple countries and multiple currencies, that involves multiple types of revenue, multiple types of currencies, and the other piece of it is ensuring that sales and services were aligned with the finance systems, because as those continue to grow, not having those aligned with the finance system was going to be a challenge. And then lastly, the continuous monitoring of the estimated selling prices as a key critical element of this. And as much as we love Excel, we didn't want to continue down that path, and so we knew we needed to automate this process. You guys have seen this type of slide before. I mean, if you're using spreadsheets, you're not alone. As a public company, we see this all the time. 90% of public companies using spreadsheets for revenue recognition, at least for some aspect of it. And so it's if you are using spreadsheets today, you're not alone. You're in the same boat with many other folks. If you're not familiar with NetSuite, let me do a very quick intro into who we are. We originally founded in 1998. We're a publicly traded company under the ticker symbol N. I'm not exactly sure how we got that coveted single letter on the New York Stock Exchange, but obviously that's an easy way to look us up. We're the second largest public SaaS company out there, and I think this is one of the, as a SaaS company, this is a real critical element of looking at these new regulations and knowing that it was going to impact us pretty significantly. As a company, we use our own platform to do this. So from an 08-1 adoption, we were using NetSuite to do that, and recurring revenue is a big part of our business and has some pretty significant impact, as well as the professional services aspect of it as well. So if you look at our revenue environment itself, we as a company, we process over 1,000 orders a month through NetSuite. Everything from leads, estimates, sales orders, billing, and then the rev rec, and that includes everything from new business, so brand new customers that come into NetSuite, upsells, so continued business from our existing customer base, and then renewals, of course. As I mentioned, we're a SaaS business, so a big part of our business is recurring revenue, and so renewals is an important part of that. When you look at our revenue aspects, there's revenue on subscription, revenue on support, as well as professional services. Now, our business is not to be a professional services house. We do professional services for in support of our subscription services and making sure that we can get customers implemented. But obviously, that is a key element of revenue that we have. There's a price list of more than 300 items, and as I mentioned at the beginning, there's over 8 currencies that we're trying to. I think that's actually up to 10 now. But the key thing there is that there's a lot of different items that we have to look at the estimated selling prices for, as well as a number of currencies. And then when you look at our revenue accounting, it was generally governed by EITF OB01 rather than 97-2. Customers cannot take delivery of our software, so we are purely a SaaS provider. So our software is never delivered on site as a CD or as a physical thing. And there was no VSOE or third-party evidence, in terms of accounting. And all revenue is deferred and amortized over the term of the contract when you look at our business. So for us, when we looked at the impact on our business, one of the big things is that it would cause subscription and PS to be broken into separate elements. So previous to adopting EITF OB01, we were reporting this as one together. The second is that we saw that we'd have to recognize the PS portion on an appropriate non-amortized schedule based on either percentage of completion or the completed contract. And then third is reporting the revenue and associated costs separately on the face of the income statement. So as a public company, this is a really important aspect because it would impact how people would look at our overall revenues, so that people could really track what's the actual element of recurring revenue that's happening versus the professional services. We run professional services at a break even. We report that, and so it's an important way to separate those two when we go and report back to the street and in our filings. So when we look at, in terms of the step-by-step process we took in terms of adopting EITF OB01, the first was, of course, looking at what are the separate units of accounting. So not all components, of course, are going to be separate units of accounting, but we're looking at subscription, the support, and the professional services. The second was, of course, establishing the estimated selling price. And this is a big part of the conversation with our auditors on what the methodology was that we were going to take. Obviously, huge amount of analysis in terms of looking at it, stratifying it, reanalyzing, going through the discussions, and then in that process also establishing the process for ongoing monitoring of our estimated selling prices as it went. This third element is I think, probably one of the most biggest changes that impacted a huge amount of the organization, was preparing the relevant line of business owners for change. And that was one of the biggest was, of course, changes in selling from a PS behavior aspect and how we took that. So it was obviously a big conversation with the sales and services staff around that. Changes in compensation, and we started to think about those elements and start to put those in process in 2010, and then in 2011 more adopted it directly into the organization. Allocating revenue based on the relative estimated selling price, so I think as Bob mentioned, really had to be thought of as this hierarchy thing. You couldn't hierarchically, you couldn't just decide, okay, we're just going to go straight to estimated selling price. You had to look at this in terms of managing your allocations, either by VSOE, third-party evidence, and then you could look at estimated selling price. I think this other piece, and I'll talk about an example here, in terms of allocation being limited by the contingent revenue. This is important. And then lastly, the disclosures and changes in external reporting. So one of the big things was services revenue and the cost of services on the P&L, and being able to report that externally was a big part of this that we did. Now, one thing that's really missing now, that's not on the slide, and I'll talk about here in a moment, is that it's not just the process aspects. I mean, obviously that's a big part of this. And it was a huge amount of effort and a huge amount of work to go and get that process element. But what it doesn't indicate is also the systems that need to happen in order to process orders in terms of the RevRec side of it. And so when you're considering what you're going to do in terms of adoption, you've got to make sure you've got the systems and processes in place, and keeping that in mind as well. So we look at, in terms of the ERP system capabilities, and look at our platform for supporting 08-1. So the first, obviously, was making sure that we were able to support the initial estimated selling price analysis. So being able to go and report on all the different sales by item, the average selling price that we've done that, not just in the prior year, but on looking at it fairly far back, and be able to slice that by all the different ways in which our selling was occurring, whether that was by different currencies, by location, by size, in some cases, whether it was standalone, whether it was bundled, etc. The second was the importance of being able to automate the allocation. So, as Bob mentioned, you can't just decide I'm going to go straight to estimated selling price. You have to do this hierarchically, and so, that was another thing, is make sure we have the capabilities to support, the VSOE analysis, third-party evidence, and the estimated selling price, and be able to automate that, whichever one was appropriate, as the case might be. And then this aspect about being able to restate prior periods or on a prospective basis is important as well. We were already public, and so one of the things we were looking at is how far back do we want to go in terms of our reporting of this. I know other companies, as they've looked at this, thought, when they were private, they weren't necessarily thinking about this, and so when they were looking at going public, they basically ended up going back and restating all the way to DEC 2005 as an example. And then lastly, the ongoing monitoring, being able to make sure that we could provide real-time tracking of the actual sales prices, as well as providing alerts as sales went outside those parameters. For example, we wanted to make sure that we be alerted of those elements and then take that into consideration as we were going forward. So when you look at the sales order complexity under 08-1, under the previous rule, so if you look at this, it's an example where the subscription itself, we sell our software as a subscription. So there's a one-year subscription for services, sales price of $2,000 in this example, and professional services $800. So $2,800 was the total price. So under the previous rule, we would recognize $233 each month and just recognize it as one single line item. When we moved to 08-1, really the key thing there was we changed, using the estimated selling price for each item to reallocate the sales order value. So in this case, what you see is that $2,100 was going to be recognized over the subscription period. So we changed that. So now it's $175 per month that's being recognized every single month, and then $700 being recognized when the professional services are delivered. So in this case, if the professional services are done in 6 months or if they're done in 3 months, whatever the case might be, they're reported in that month they're delivered, as opposed to before where we were recognizing them evenly across each of the months that were done. Taking this a little bit further and a little bit more complex example, when you look at the allocated value calculation, if you take the same example where you've got subscription services and professional services, where the subscription services delivered over a 12-month period, professional services over 3 to 6 months, again here where we put an estimated selling price assumption with subscription items of $40,000 and the professional services items of $10,000. Let's look at an example of how that could be affected if the based on the estimated selling price. So in this case, where the order value, as you can see here on the numbers, the subscription items are $65,000 versus the PS items are $23,000. So if you look at the estimated selling price allocation that's there, you can see the allocated values that are put in place there. So $70,400 that gets allocated based on the estimated selling price value to the subscription items versus $17,600 that gets allocated to the PS side of things. So in this case, the revenue allocated to professional services is less than the contract amount, so there's no impact on the contingent revenue. We just recognize based on the allocated amount, and you move forward. But in the second example, where the subscription item is $65,000 versus the PS is $12,000, in this case, where the allocated value is actually higher than the order value, and so there's a contingent revenue limitation in this example. And so what we have to default back to is the contract value in terms of what we can recognize here. So you can start to see, some of these complexities become really important in terms of the automation of that and making sure that we keep these in mind and considering them in terms of that process. So we look at our overall approach to 08-1. We really take a holistic approach to 08-1. We take a strategic approach to revenue recognition. So our systems itself provide the core accounting functionality, centralizing sales, finance, and services information to drive the calculation of the estimated selling prices, but really integrating services and finance data to drive rev rec from services delivery, integrating the sales and finance data to automate the conversion of a sales quote to a rev rec value, and then the dashboards and analytics to deliver ongoing monitoring and alerting of what's happening in the business. And because a big part of this is we run our business on our platform, which means our business systems are closely aligned to enable us to take advantage of these new rules. And that was really what allowed us to take advantage and be an early adopter in 2010. And what we've done now is continue to make it a priority to ensure that our system can continue to support the changes that are occurring, and then leave us in a strong position to ensure that they're not a roadblock to moving forward, to selling to customers as we need to, and that our systems aren't a roadblock to what we need to do in terms of booking revenue or to running our business. So kind of just to summarize in terms of some of the lessons that we learned in terms of being an early adopter and just looking at this overall, starting the process itself, at least 3 to 6 months before adoption, in terms of being able to determine your separate elements, but also the methodology and the ESP calculation, and then that was an important part of it. The second, which I mentioned again, and I'll say again, is the impact on the groups outside of finance. Finance recognizes they're going to need to do this, and they have, they're going to prepare accordingly. The sales and the services side is a whole other conversation, and it's an important part to plan for the impact on what will happen to those groups. The third part here is, in terms of planning for the automation. Just doing this with spreadsheets, you may be able to do it at the beginning, but it starts to get very, very painful, and so it's a big part of planning for it in the process. When are we going to automate, and how are we going to automate? In terms of the timing, and make sure that's tied with the overall plan. Fourth, as I showed with that example, where the complexity can happen, is considering the contingent revenue as an important element of this. As depending on what happens, that can be an important consideration. And then lastly is the continuous monitoring. It's not just one and we're done, and we can move on. There has to be continuous monitoring as behavior changes, as selling behavior changes, and making sure that you're staying within the parameters you've set. And then as your alerted changes, then you're working accordingly. So with that, let me turn it back over to John, and then take any questions that we have.
Wonderful. Thank you, Rhonda. Appreciate that. Really well covered. That's a great view into how you guys dealt with the adoption at NetSuite. We've got a handful of questions here. I'd like to encourage folks to ask any other questions they'd like, because we've got a good slug of time to go back and forth with the presenters. So let's start with a question for Bob. Bob, in terms of what you're seeing as adoption time for companies, how long in general has it taken your clients from the moment they said we're going to the moment they're completely done to adopt and adjust these new regulations?
John, I hate to answer any question with a big fat "it depends," but certainly, I have some, so my client base ranges from kind of earlier stage, venture-backed companies that have got a very small collection of products and a couple of $1 million in revenue, up to the low 9-figure range. So so it does depend, and I think that some of the driving factors are, the complexity of the bundles that you sell. So you're talking about, a simple, product plus a product warranty, really simple 2-element arrangement situation, to something that is much more complex with products, tangible products, intangible products, service contracts, professional services. So I think that the bigger the bundle, the longer the lead time, and then without question, and I'll use a manufacturing term, the more SKUs you have, and the more geographies in which you operate, add complexity. So as a point of range, I've certainly had some clients that could the smaller, simpler clients that could manage this really with a good week's worth of work. But I think that if you start to look at companies of substance that have a lot more going on, I would sign up for what Ranjit said in terms of his 3 to 6 month lead time as being a good window. Because again, when it's not just about there's the element of it which is about setting the prices, but then the impacts on the other parts of your organization and sales behaviors and tying that into if you've got commission plans that are designed around revenue under the old rules versus the new rules, and then you go from spreadsheets to systems. So I think that just getting all your estimated selling prices is a pretty significant effort, but there's a whole lot of, I hate to use the word collateral damage, there's just a whole lot of other constituencies that need to be managed as a part of the process, such that it's hard for me to envision something other than that 3 to 6 month window for a company that has any complexity to it.
Mm-hmm. Hey, John, if I can...
Yeah, by all means.
Oh, no, I was going to say if I could add a little bit to that element that Bob just reminded me. The commission aspect of it is a critical thing I forgot to mention in our own adoption because, like I said, the behavior changed in terms of how we were starting to allocate for professional services, and so that had an impact on sales and commission, and so we couldn't in mid-year suddenly change how we were paying our salespeople, so we had to keep that in mind for 2011 when we started the year fresh, but that was a huge consideration, and so that also added in terms of timing, in terms of adoption to think about what that would require.
Gotcha. Thank you for that. Now, I know from my own, unfortunately, many CFO or software company experiences that back under 97.2, you would protect VSO if you had it. So if companies set a level of, let's say 20% maintenance off their license fee, you would never allow your salespeople, your legal team, anyone to change that part of an agreement with customers because you could risk losing VSO for your other elements, or for that element, and then your rev rec for the other elements. This, in some ways, frees companies up, doesn't it, Bob, and allows them to be a little more wide-ranging in the deals that they strike.
Oh, John, without question. I'm sure that there are many salesmen in the world whom I have never met who still curse my name because I'm the one who told the CFO that they had to lock in at a maintenance rate, and then the CFO could tell it, and the CFO gets it, and then but when he's rolling it out to the sales force, you will never charge anything but X for maintenance, they can blame the auditors. So, as I kind of mentioned earlier, there's a tremendous amount of freedom that comes from the new rules, but with that freedom comes great responsibility. And so I think this is what the world has been kind of clamoring for. I think the world is tired of rigidly proscriptive accounting rules and wants the ability to use more judgment and to not let an accounting tail wag a business dog. And so this is a flavor of that for sure. But it comes with a lot of unintended consequences from just the amount of work that it takes to estimate selling prices and maybe taking shackles off of a sales force that you kind of secretly like to have in shackles because you're afraid of what they do if there aren't rigid rules that you can pound them over the head with. And so there are a lot of considerations outside the accounting department that need to be taken into account here.
Ranga, was that one of the biggest challenges in doing your rollout, communicating, getting everyone in line? I guess now you have to create a whole new set of rules for pricing for your sales force.
I mean, like I said, I think I mentioned it, in the slides. I mean, it should not be underestimated just the effort in terms of getting the broader organization on board. I think that was an element that I wouldn't say surprised us in any way. It's just there's a lot more people than just finance that get impacted here, and so it definitely wasn't a big aspect of it. But it was also then thinking about commissions and how that we needed to think about commissions and how that affected it. Thinking about how we reported certain things in terms of making sure that we had in our systems the ability to recognize, this if we're going to do it based on percentage of completion or we're going to do it based on milestone billings and things like that. you needed to have that reporting built in so that you're allocating for that from a revenue perspective as well. So all of those elements, I think, it's like the as Bob the phrase Bob used, the collateral damage aspect, goes much further than finance in terms of thinking about this.
Yep. Bob, have there been any substantive comment letters issued by the SEC to public companies post-adoption? And if so, what have the most highlighted items been?
I have not seen any, which is different than saying that there haven't been. It just means that in my corner of the world, and in talking with one of our guys from our national practice, we haven't seen a ton of activity here yet, and that's probably not unexpected, just given the newness with it and the relatively slow speed with which the SEC will sometimes pick up on new issues. And if you consider it, there really weren't any companies adopting this earlier than last year, and a lot of those 10Ks you just got filed in the spring, and so I think we're entering a period of time where we can expect to see more activity here. I have a client that is going public right now, and that is retrospectively adopting these rules. As I think Ranja mentioned earlier, it just makes good sense for them to go public with all of the historical information lining up to the current area. And as we're thinking about what these footnotes will read and whatnot, we are certainly doing it with an eye towards drawing a comment. An IPO prospectus will always draw a comment letter or more from the SEC. So the company is putting the level of rigor into it and drafting footnotes for it on the expectation that they will have to defend it. As to whether the SEC will go real deep and start asking for copies of the analyses and stuff, I would say that they do that sometimes. So the SEC is kind of all over segment reporting sometimes, and they want to see, they won't just take your word for it, they want to see what information decision makers are using. And if you've ever had to throw a valuation report to the SEC staff, you know how painful that can be when they start thinking they know more about valuation work than valuation experts. You couldn't rule out the idea that someday that companies will be asked to, especially if the initial answers don't quite hold together on a qualitative basis. You could see a day where the SEC would, in a follow-up letter, ask to see some of those analyses. But that's hypothetical, John. I haven't seen that yet.
Gotcha. Okay. Another question, probably for you, Bob. Someone who's writing in from a software company, and they have a, quote, initialization fee, which includes things like scope of work, development, training, delivery, and initiation of the platform. Would this be considered another element in the arrangement, another unit of accounting, and therefore would have to have its own ESP assigned and then figure out the treatment of that element, et cetera?
Well, I think I heard you mention, just as you were getting that one started, John, that this was a software company. So I guess I'm going to.
It's a SaaS company, actually.
Oh, SaaS company. Sorry. Okay. So a SaaS company would be outside of 97.2.
Right.
Yeah. I guess my question on that is whether there is a bona fide deliverable, associated with that, or whether it is, kind of a non-substantive deliverable that is just a good cash flow convention. So I think the new RevRec standard, whenever it comes out, is going to provide some more guidance on what constitutes a deliverable. And I think they use the term, like an obligation, like what obligations do you have to your customer as a result of this contract. As we stand today and we use the term deliverable, I would still look at those upfront fees, I think, with a somewhat skeptical eye in terms of whether there is, you're forgetting about the estimated selling price and sales price allocation guidance. I still look at some of those in the SaaS companies. I still look at some of those upfront services and ask the question, do they have standalone value to the customer? Because before you can get into all the cool new estimated selling price literature, you still have to meet that first standard, which is, I've delivered something, and there's other stuff I haven't delivered. This thing that I've delivered, does it actually have standalone utility from the perspective of the customer? And if it is fundamentally setup type fees, the answer is frequently no, so those aren't eligible as a separate unit of accounting. If it is some sort of needs assessment, the answer becomes closer to yes. And if the answer is, yes, this has standalone value to a customer, then the answer is also, well, then yes, you must follow the hierarchy in order to assign value to it.
And on a related subject, and once again, let's not talk about software companies that might be under 97.2, but just in general, if you sell a product that comes with a warranty, 1 year, 2 year warranty, do you have to break that value out separately and recognize a portion of the sale, some portion of whatever you're selling over the warranty period?
Yeah, I would. Now, of course, warranty accounting. I think this is one of those areas, John, where we could end up with a different answer under the new RevRec guidance, in which I think quite clearly that definition of what is my obligation to the customer, that would clearly be an obligation to a customer, and I think that when the new framework comes out, that is, again, something that would very likely be considered an element of an arrangement. I tend to think of a product warranty today. I mean, I don't know if we're talking about a situation in which I'm selling or if it is simply, kind of a free warranty in which you would end up in kind of the FAS 5, accrual route.
So this might be one of those areas where someone needs to seek a little more detailed guidance and get into facts and circumstances and all of that good stuff.
Sure.
Okay. Gotcha. Sorry, folks, we can't answer every question because a lot of these go very deep into the specifics of your business. Bob, sorry, once again, I'm picking on you here. Once the FASB and IASB issue a new standard on revenue recognition, what do you think the adoption lead time will be? How ready to jump do you think companies will need to be? Is there a pattern that's been emerging from recent work from those bodies?
Boy, that is it's a great question, and quite honestly, and unfortunately, one without an answer. The original exposure draft came out, and that was one of the questions that the FASB posed to the world was, what do you think the adoption criteria ought to look like? I mean, if we look at some of the more recent pronouncements to come out of the FASB, they have in many cases permitted for either a prospective or retrospective application, and both of those come with different sets of disclosure obligations. You could certainly see that as a regime on this one. Now that we're certainly looking at a situation in which, just to go over the math again, Q3 new exposure draft, 120-day comment period, followed by some ongoing deliberation, presumably a little shorter than last time. But it's inconceivable that they would publish a final standard until, let's call it, Q2 of next year. I just don't think the math would get you there really much faster than sometime in Q2 of next year. So that's 2012. And certainly there would not be an immediate adoption criteria, so you can kiss 2012 goodbye. It's hard for me to imagine an adoption of earlier than 2013, but even with that being theoretically possible, I think that if the FASB is smart, they'll recognize some of the very significant systems and process issues that accompany this. It's not something, digesting and applying the new RevRec standard will not be an overnight sensation. So I'd like to believe that there will be a fairly protracted period of adoption for that. And as we've seen in the past, when the FASB has ultimately cut it too short, they have not hesitated with enough, I guess, kind of whining from us all. They have not hesitated to extended periods. You look at some of the consolidation criteria under the old FIN 46. A lot of the derivative literature was punted downstream on more than one occasion when it became clear that the original adoption dates were unrealistic. So I think, so 2012 is out. I would hope that they wouldn't force this down everybody's throats for 2013. So maybe a late 13, early 14 would be something that if I was writing the rules, I would probably set for an initial target.
Gotcha. Okay, great. Well, look, that is our time today. Let me take care of a few housekeeping items before I bid everyone goodbye. First off, thanks to Bob Burke and Ranga Bodla for their time and insight. Wonderful information today. Really appreciate it. gentlemen, and happy to have you on. If anyone in the audience would like us, being Performative, to help you connect with any of the speakers from today, please indicate that on a survey that we are going to send out to everyone. First off, we appreciate you filling out the survey. We always want to know how to do this better the next time. But we'll also ask you, for both Bob and Rhonda, whether you'd like us to help you connect to them if you have follow-on questions. I know they'd be more than happy to help you out with those. So please take a look at that when you get the survey. Thanks to today's sponsors, both McGladrey and NetSuite. We couldn't put these events on without our sponsors' support, and everything we do at Performative is free for our users. So that's wonderful, greatly appreciated. If you have any questions about CPE credits, feel free to send them out to Tanya Walsh, who is our event manager and CPE manager. Her email is at the bottom of the slide here. I mentioned earlier we'll be sending a survey out. We would greatly appreciate your taking just a minute to fill it out and get that back to us. Finally, thanks to the audience for your time. I know everyone's incredibly busy these days. It's difficult to do anything like this, even if it's for your own good. We hope we succeeded in getting you great and useful information this morning, and we look forward to seeing you again at another event or online at performative.com. Thank you very much, and with that, we'll bid everyone a wonderful weekend. Take care, all.